and welcome to the Open House. We bring to you a special series all about FMPs. You may have read of late a lot of problems that some of the FMPs have been going through. We try and understand and decode these problems and what it means to your investments. Fixed maturity plans have been a fairly favored instrument of a lot of investors in the recent past. What has really happened is that some of the FMPs have found it difficult to recover the money which they had invested in certain corporates. Now, FMPs were touted as a good competition to FDs, more tax efficient, better returns. Does that still hold true? Let us find out from well-known certified financial planner Surya Bhatia. Thanks very much, Surya.
Thank you.
I'm sure you've been very busy getting calls from people around what's going on. It's almost like a crisis, isn't it? Because it's not one scheme, it's not one fund house, it's a few of them now, and more schemes seems to be getting into this whole crisis that they are unable to pay investors the money that they didn't guarantee, but in some way promised.
Yep.
Right.
I think, Vivek, what you're saying is actually very true. FMPs are facing crisis-like situation right now. And especially you find the months of April to June, typically FMPs, while are available across various time horizons, they can be from 1 month to, let's say, 5 years typically. But since the tax rules have been changed for debt taxation, when the more than 3 years of holding qualifies a debt for a long-term capital gain, and hence the benefit of indexation and a lower tax rate. So most of the FMPs coming now are a typical 3-year and 3-year plus.
Okay.
Now, what is happening is that you find a trend, which is rightly so, that FMPs typically come out more in the months of Jan to March, JFM, as is popularly called. And the intention being that you can hold the FMPs for, let's say, 3 years, 3 months plus, which means you're holding the FMP for 39 months or 37 months also, with the intent that you're holding for typically 3 years or thereabouts, but you are able to get the benefit of indexation for 4 years because you're crossing the 4th year cycle.
Okay.
And because of that, it actually, which is a tax efficient instrument, it becomes even more tax efficient. And in a way, if I can say that, is that they virtually become tax-free asset classes for a 3-year period. So if my coupon is actually happening at a 7.5%, and for an investor with 7.5% tax-free or thereabouts, very low tax rate, then it's a brilliant instrument. So therefore, now April onwards, for the next 2 to 3 months, you are seeing lots of these maturities happening of the FMPs which were done before the 3-year period, and now this crisis coming into play just adds cost to it. So now look at this. You're seeing, and it's actually all started, I think, from September of last year, September of 18. You were seeing a crisis happening on Jet Airways, you're seeing crisis happening on ILFS, where all it started from.
SL Group.
SL coming into foray now. And I think, if not all, most of the FMPs are actually holding these bonds, debentures in various forms and nature. Even some of them actually even holding zero coupon bonds, which you're not even seeing on the paper right now, because there is no interest payout on these bonds. But when they come for maturity, in case they are not able to kind of service the debt, they're not able to pay that bond back, the principal back with interest, there's a default-like situation. And that's not even coming into foray right now. So definitely, things are not looking that bright. They had to really tighten their belt. And yes, I think fund managers to a certain extent also did not do a due diligence. Some of the credit rating agencies also did not do a due diligence beyond a point. I think with a rating of a AAA, and then you say the next day you say the paper has gone to a junk status, I think that says a lot on the credit rating agencies in our country. So that's something we need to ponder on, but that's for a different topic and different day. But otherwise, from an investor perspective, from an investor point of view, I think the cue is you need to understand what you are buying. You need to understand that no asset class is a guaranteed return asset class. There comes a risk. So if we define a risk, now a concept could be, let's say there is a return which is called as a risk-free return. Now, how do you define a risk-free return? In a typical manner, it's my GSEC, it's my government securities return in my benchmark, which is actually the benchmark for a risk-free return. For a retail investor who typically cannot buy a GSEC security. You can always call a bank FD, loosely worded, a bank FD as a risk-free return, while they are also not risk-free because the Banking Regulation Act puts a cap of 1 lakh rupee on the banking deposits. But assuming for a minute that's a risk-free return, that's what your benchmark is. If you are trying anything superior to that return, there has to be an element of risk attached to it. That's it, period. You cannot say, I look at a 7% FD rate and I want to do a 7.5%, there is no risk. For that extra 0.5%, the risk degree may be lower, but the risk is surely there. Now, it's your call, it's your investor's call. How do you want to manage your risks and risks well? So, from a recommendation or from our people who are listening to us, our investors, they need to be sure that what they are buying, they are happy to take a little bit of risk in the portfolios if they want to have an FD plus kind of a return.